Okay, great. Well, hello everyone. Thank you for joining us this morning for our webinar. My name is Ailish and I'm an associate analyst here at Planet Tracker. And over the next hour, we'll be exploring the methane footprint targets and reduction plans of 52 of the largest meat, dairy, and rice companies and how this translates to financial materiality. I'll then be passing over to Chen Tong, the China program manager at the FAIRR initiative, to introduce the methane policy and FAIRR's largest engagement, focused on the China agri-food industry, with the largest Chinese animal protein producers and case studies illustrating current corporate practices. Just some quick housekeeping before we start. If you have any questions, please add them to the Q&A function, as we will have a section at the end where we can answer them. But in case we can't get to them on the webinar, we will reply via email later on. And lastly, we will be recording this webinar. So before we kick off, I just wanted to take a minute to introduce Planet Tracker to those of you who aren't familiar with our work. So Planet Tracker is a sustainable finance think tank conducting research on nature-related risks and opportunities. You may have heard of our sister company, Carbon Tracker, who work on the energy transition, whereas Planet Tracker is focused on biodiversity and nature. So we focus on the drivers of biodiversity loss, specifically land and sea use change, exploitation of natural resources, pollution, and climate change. And we provide in-depth research reports on each of these topics, covering a range of industries and themes, as you can see in the slide here. We are not for profit, so everything we do is for the common good, and all of our research is publicly available on our website or on your usual finance or financial data platforms. And with that being said, let's dive into the webinar. So the focus of this section, as I said, is examining the methane footprint targets and reduction plans of 52 of the largest meat, dairy, and rice companies and how this translates to financial materiality. And feel free to scan the QR code for the report here, but we will also share it with you after the webinar. So today we're focusing on methane from agriculture and why it represents a material near-term financial risk that is still largely mispriced in capital markets. So methane is particularly important because reducing is one of the fastest ways to slow near-term warming. But for investors to act effectively, they need to understand where emissions are concentrated and how credible company targets actually are. So our analysis comes from Planet Tracker's Methane Matters report, where we assess the methane footprints, targets, and action plans of 52 of the world's largest meat, dairy, and rice companies. And one of the most striking findings is how concentrated these emissions are. So together, these 52 companies account for 12% of global agricultural methane emissions. But within that group, the concentration is even more extreme. So the top 10 companies account for more than 80 or 68% of total emissions. And JBS alone produces over a quarter of the group's methane footprint. So for investors, this means methane risk is highly issuer specific rather than diversified across portfolios, making it a clear engagement and transition risk priority. So across the 52 largest meat, dairy, and rice companies analysed in this report, methane disclosure is extremely limited. So only 7 of the 52 companies disclose any methane emissions data at all. And given the scale and concentration of emissions we discussed in the previous slide, that level of transparency should raise concerns about preparedness and risk visibility across the sector. But the problem is not only how many companies disclose methane, but also what they disclose. So among the companies that do report methane emissions, most disclosure is limited to Scope 1 emissions, those generated from company-owned operations such as processing plants, slaughterhouses. But in the context of agriculture, however, this provides a very incomplete picture. So the vast majority of methane emissions occur upstream at the farm level, not within corporate-owned facilities. And for meat and dairy companies, methane is primarily produced through enteric fermentation, where cattle release methane during digestion. Whereas for rice companies, methane is generated in flooded paddy fields, where anaerobic conditions allow methane producing bacteria to thrive. So both of these sources fall under Scope 3 emissions rather than Scope 1. So when companies disclose only scope one methane emissions, they're effectively reporting the least material part of their methane footprint, while the dominant source of emissions remains largely invisible. So from an asset management perspective, this creates a significant distortion. Reported emissions figures can materially understate a company's true methane exposures, sometimes by a very large margin. So this means that methane risk is often not fully visible in corporate reporting, not captured accurately in emissions inventories, and not reflected in many portfolio level climate risk assessments. So among the 7 companies that report methane emissions, 2 meat companies disclose methane, but only for scope one. One rice company discloses scope one methane only, and 4 dairy companies provide partial methane disclosure, often limited by geography, uh, product category, or emissions boundaries. So only Danone provides relatively broad disclosure covering scope one and a substantial portion of scope three methane emissions from its fresh milk supply. And even in that case, this disclosure roughly covers 70% of its methane footprint, not the full supply chain. So even the strongest disclosure in the sample remains incomplete. And for investors, that matters because disclosure underpins risk pricing. If methane emissions are measured and disclosed, are not measured and disclosed, they are unlikely to fully reflect or to be fully reflected in equity valuations and credit risk assessments. So the key takeaway from this slide is that methane disclosure is weak, and that weak disclosure hides real financial risk and delays corrective action. So then moving from disclosure to targets, because this is where the gap between stated climate ambition and actual or methane management becomes very clear. So across the 52 meat, dairy, and rice companies analysed in this report, the overall picture on methane targets is stark. Only one company, Danone, has set a clear, quantified methane specific reduction target, and that target commits to reducing methane emissions from its fresh milk supply by 30% by 2030, covering both scope one and a substantial portion of scope three emissions for their product category. Every other company in the sample, including some of the largest meat and rice producers globally, has no standalone methane target at all, despite methane accounting for a significant share of their total climate footprint. So to understand why this matters for investors, it helps to distinguish between 3 different types of targets companies use. So first is methane-specific targets, which directly address methane emissions as a distinct greenhouse gas. Second is broader greenhouse gas targets that include methane, usually embedded within scope one, two, or three emission goals. And third is targets that effectively exclude methane, either explicitly or because the emission sources where methane occurs were not covered. So our report finds that 24 of the 52 companies have set some sort of greenhouse gas target that technically includes methane, but very few treat methane as a priority in its own right. In practice, methane is often folded into broader carbon narratives where its unique climate properties are lost. This matters because methane is not just another greenhouse gas, it's more than 80 times the warming impact of CO2 over a 20-year period, but it also has a short atmospheric lifetime of around 12 years. And that means reducing methane is one of the fastest ways to slow near-term warming. So for asset managers, the absence of methane specific targets raises several concerns. First, transition risk. Companies without methane targets are unlikely to be prepared for future methane regulation, disclosure requirements, or supply chain standards, particularly given the growing policy momentum behind methane reduction. Second is a credibility risk. Many companies have announced broad net zero commitments, but without methane specific targets, there is often a disconnect between stated ambitions and the emissions sources that matter most. And third, a comparability risk. Without methane specific targets, it becomes difficult for investors to benchmark companies against one another or against policy aligned pathways, such as the Global Methane Pledge. So dairy companies generally perform better largely because methane represents such a visible share of dairy emissions and because industry initiatives have begun to emerge. However, even in dairy, methane targets remain the exception rather than the rule. Meat companies perform worse, with very few setting Scope 3 targets that meaningfully address methane. And rice companies perform worst overall, with most failing to set any near-term greenhouse gas targets at all, let alone methane-specific ones. So then this slide is one of the most important in the presentation because it explains why many corporate climate targets do not necessarily reduce methane risk for investors, even when they appear ambitious. So across the companies analysed in our report, a common pattern emerges where targets exist. They are often emission intensity targets rather than absolute reduction targets. And it's important to distinguish clearly between the two. So an absolute emissions target commits a company to reducing the total volume of emissions it produces, regardless of how much the business grows. Whereas an intensity target, by contrast, commits a company to reducing emissions per unit of output, for example, per ton of meat or per litre of milk. On the surface, intensity targets can look credible and often are presented as evidence of progress, but in sectors where production volumes are growing, which is the case for meat, dairy, and rice, intensity targets can still allow total emissions to increase. So the report illustrates the challenge using projected growth rates for the meat sector. And global meat production is expected to grow by about 1.2% per year through to 2034. And now, considering a realistic scenario, a meat company sets an intensity target to reduce methane intensity by 30% by 2030, while its production grows by roughly 4% per year, which is well within historical norms for large producers. And when you run the numbers, even if the company meets its intensity targets, its absolute methane emissions still increase over time. So, in other words, the company still claims success against its climate targets while actually worsening the problem from a climate and policy perspective. So, from an asset management perspective, this has several implications. First, intensity targets do not align well with emerging policy pathways. So, the Global Methane Pledge calls for a 30% reduction in methane emissions by 2030, not a reduction in emissions intensity. Second, intensity targets can obscure real exposure, so absolute emissions determine regulatory exposure, reputational pressure, and contribution to warming. And if absolute emissions continue rising, so does the underlying risk. And third, intensity targets make comparability difficult. So two companies may report identical intensity improvements, but have very different absolute emission trajectories depending on growth rates or changes in production. So we've been looking at disclosure gaps and weaker absent targets, but this slide addresses what is arguably one of the most serious issues from an investor perspective, and this is implementation. Because even the best targets are meaningless if investors cannot see how they will actually be delivered. So our report assessed whether companies publish standalone methane reduction plans, so plans that an investor could realistically evaluate, monitor, and underwrite. And the finding is very clear. Not a single one of the 52 companies analysed discloses a standalone methane action plan. Instead, methane is usually embedded within broader net zero strategies, generally greenhouse gas frameworks, or large high-level sustainability commitments. And these documents often contain ambition, but very little operational detail. So from an asset management perspective, this creates a fundamental problem to assess whether a transition pathway is credible. Investors typically need visibility on at least a couple of things. So, which methane abatement levers will be used, how much each lever is expected to reduce emissions, when those measures will be deployed, and how implementation will be enforced across supply chains. And across the companies analysed, none provide all those elements, and most provide very little information at all. So this challenge is particularly significant in agriculture because companies do not directly control most methane emissions. Unlike emissions from owned facilities, agricultural methane is generated at a farm level across fragmented supply chains and often in regions with limited regulatory oversight. So, as a result, companies cannot reduce methane simply by changing their own operations. They must instead influence farming practices across their supplier network. So, for example, by providing technical support, financial initiatives, or integrating methane reduction requirements into procurement contracts. However, very few companies explain how they will actually do this in practice, and many strategies refer to supporting farmers or investing in innovation, but these statements are rarely accompanied by quantified emission reductions, clear timelines, or commitments to scale solutions across supply chains. So, from an investor perspective, this makes it extremely difficult to assess delivery risk. And a target without a delivery plan is not a commitment, it's an intention, and intentions are not something investors can price. So then this slide shifts to the discussion from corporate strategy to capital allocation. Because even where money is being deployed to address methane, it is often not flowing to the areas that reduce risk most effectively. So our report estimates that around 16.5 billion US dollars per year in methane abatement investment will be required by 2030 to align to agricultural emissions, with pathways consistent with limiting warming to below 2 degrees. And this estimate draws on climate initiative or policy initiative analysis and reflects the scale of intervention required across agriculture. And at a first glance, this might look like a significant opportunity for investors, but when we examine where methane abatement capital is actually flowing today, a major mismatch becomes clear. So, according to a report, around 85% of livestock methane abatement finance currently goes to manure management, particularly manure to energy projects such as anaerobic digesters. And the problem is that manure only accounts for about 10% of livestock methane emissions. The remaining 90% of livestock methane emissions comes from enteric fermentation, the methane produced during the digestive process of ruminant animals such as cattle. And this means that there is a significant mismatch between where emissions originate and the capital is being deployed to address them. So, from an investor perspective, this represents a clear case of misaligned capital allocation. And digesters have become a dominant solution largely because they produce a tangible energy output and benefit from renewable energy subsidies, as well as fit well within existing infrastructure and financing models. However, digesters only capture methane from manure after it's produced. They do not address enteric methane, which is by far the largest source of emissions in livestock systems. So this slide shifts to focus on relative positioning because for asset managers, the key question is not only how large the problem is, but which companies are better prepared and which are more exposed to transition risk. So the report therefore distinguishes between relative leaders, middle performers, and high risk laggards based on disclosure quality, target credibility, and implementation readiness. So it's important to be clear from the start, there's no true leaders yet. What we still see instead are relative leaders, companies that are moving earlier or faster than peers, but still fall short of what would be required from alignment with the global methane pledge. Starting with the relative leaders, the report finds that dairy companies generally perform better than meat and rice companies. And this is not because methane emissions are small, they're not, but because methane represents a very visible share of methane or dairy emissions. So dairy supply chains are often more organized and sector-specific initiatives have begun to emerge. Among those companies, Danone stands out most clearly. Danone is the only company in the 52 company sample with a clear methane strategy or specific reduction target, committing to reduce methane emissions from its fresh milk supply by 30% by 2030 and covering a substantial portion of its scope 3 emissions. Other dairy companies, including Erla, Fonterra, and Nestle, also perform relatively better than the rest of the sample. So this slide addresses the next question investors should ask, which is why does methane matter now? Um, the answer is a combination of methane's physical characteristics, growing policy momentum, and how transition risk tends to emerge in markets. So first, methane has a short atmospheric lifetime of around 12 years compared to carbon dioxide, which can remain in the atmosphere for centuries. And because of this, methane emissions have a disproportionately large impact on near-term warming, particularly over the next 1 to 2 decades. Methane was responsible for roughly 30% of global warming since the Industrial Revolution, despite representing a much smaller share of total greenhouse gas volumes. From a policy perspective, this makes methane an extremely attractive mitigation target. So, cutting methane can deliver faster climate benefits than reducing CO2 alone. And as a result, methane has moved rapidly up the global policy agenda. So, the Global Methane Pledge, launched at COP26 and now endorsed by more than 150 countries, commits signatories to an absolute 30% reduction in methane emissions by 2030. And that target is increasingly becoming used as a benchmark for national policy, corporate accountability, and emerging disclosure frameworks. For investors, the key point is that methane has become politically prioritized. And when environmental issues become politically prioritized, financial risk often follows. This slide then focuses on what all of this analysis means in practice for asset managers. So up to this point, we've established that methane exposure in agriculture is large and concentrated, disclosure is weak and inconsistent, targets are often absent or poorly designed, and credible implementation plans are largely missing. But the next question for investors is what should companies be expected to do? So first, investors should require comprehensive methane disclosure covering both Scope 1 and Scope 3 emissions. As we discussed earlier, Scope 1 methane represents only a small share of total emissions for most meat, dairy, and rice companies, and the majority of emissions occur upstream at the farm level and sit within Scope 3. Without Scope 3 disclosure, investors simply do not have visibility into the real scale of methane exposure. Companies should therefore disclose methane separately from CO2, explain the methodologies used to estimate emissions, and provide clear coverage of supply chains. Partial disclosure should be seen as a starting point, but not an end point. Second, investors should push for absolute methane specific reduction targets. So methane has different policy relevance and mitigation timelines than carbon dioxide. And when methane is folded into broader net zero commitments, accountability becomes weaker and progress becomes harder to measure. So the report recommends that companies adopt standalone methane targets aligned with at least a 30% reduction by 2030, consistent with the Global Methane Pledge. And these targets should focus on absolute reductions rather than intensity-only metrics, because absolute emissions determine real climate and regulatory exposure. Third, investors should expect time-bound implementation plans. So targets alone are not enough. Companies need to explain how methane reductions will actually be delivered. And this includes identifying the abatement levers that will be used, setting timelines, excuse me, setting timelines for scaling those solutions and describing how adoption will be implemented across supply chains. Because most agricultural methane occur at the farm level, companies should also explain how they will engage farmers, provide incentives, and integrate methane requirements into procurement and supplier relations. And then finally, investors should encourage capital allocation towards high impact methane solutions. So, as we saw earlier, current methane finance is highly or heavily concentrated in manure management solutions. And even though manure represents a relatively small share of livestock emissions, investors should encourage companies to prioritize investments that address the largest methane or emission sources, such as enteric methane reduction technologies. So, to close, methane is one of the fastest opportunities available today to reduce near-term climate risk, but that opportunity only exists if methane is measured, targeted, and acted upon. Our analysis shows that across the global food system, emissions are highly concentrated, disclosure remains limited, and credible reduction strategies are still the exception rather than the rule. So, for asset managers, this creates both a risk management challenge and a stewardship opportunity. Engagement focused on better disclosure, credible targets, and real implementation can materially reduce methane exposure and help move the sector towards target or science aligned pathways. Thank you, and I'm happy to pass now to Shantong.
Thanks, Alice. So I share my screen. Hi, everyone. I'm Chang Tong from FAIRR Initiative, based in the UK. I lead FAIRR's work in China. Today, I'm going to briefly introduce FAIRR and the climate policy in China, FAIRR's engagement with Chinese companies, and the relevant progress. So FAIRR is a non-profit organization with over more 400 members, with combined assets of 90 trillion US dollars. Our diverse global network comprises both asset managers and asset owners. And also in China, over the last 3 years, we've been exploring the membership with Chinese asset managers and also BCP firms. We currently have around 10 investor members in China. And then also there's no fee for becoming a member and no reporting requirements. The global food system is vast, and then there are many different angles one can take. But at FAIRR, we focus specifically on intensive animal agriculture due to its impacts on climate, nature, and social goals. Here are 4 examples as to why the risks are material and relevant for investors. As you can see, animal agriculture accounts around 14% of global GHG emissions. 77% of agricultural land is used for animal grazing and food production. Similarly, animal agriculture consumes a lot of fresh water and antibiotics. What the material risks and opportunities in this sector? So FAIRR has identified the 11 factors as the most material for the sector, so including 9 risk factors and 2 opportunity factors. From a risk perspective, we cover GHG emissions, water use and scarcity, deforestation, waste and pollution, etc. But it's not all about risks. The sector has seen promising technologies such as food tech that offers investor opportunities. So how do we help investors? Our research tools and engagement covers the whole value chain. We cover the import provider upstreams, such as the pharma and pharmaceutical companies, and all the way to downstreams, passing the protein producers, manufacturers, retailers, and restaurant chains. Our research cover around 100 global listed companies via public available information, and our research team does all of our analysis in-house. Next, let's focus on China, starting with policy. So at the highest level, everything sits under China's dual carbon goals. The peak emission before 2030 and reaching carbon neutrality by 2060. That gives the overall direction for climate policy. And I think today is a very good right timing because it's a kind of the period to release the the latest 15th five-year plan in China, and then the 2025 NDC updates, which could be the very significant. It includes China's first economy-wide absolute emission reduction targets. And most importantly, this would not just cover CO2, but also the methane and other greenhouse gases. So looking specifically at methane, the 2023 Methane Emission Control Action Plan is the key development. It's the China's first dedicated methane policy, and for the livestock sector, it puts clear attention on manure and biogas, waste treatments, and methane monitoring. So finally, the China Certified Emission Reduction Scheme, which is a market mechanism piece. China's voluntary carbon market could help create financial incentives for projects such as methane reduction from pig manure management. I will share more information on that later. Before introducing CCER, I want to share that the integrated crop livestock circular model in China, which can be described as a closed loop system that starts from pig farm facilities on manure resource utilization and connects livestock production with croplands, cultivation, and feed processing. So in the left side, you can see this in China because of vertical business model. So this what you can have a brief understanding what the Chinese pig farm looks like. So basically, the Chinese pig farm will have the feed facilities and also facility to deal with manure and also the crop lands around those facilities could plant the crops for the feed processing. And at the pig farm level, manure and wastewater generated during hog production are brought into a treatment system based on anaerobic digestion. The farm waste is fully treated through anaerobic processes, and after which the material is separated into solid and liquid manure for further utilization. This treatment step is the central component of the company's crop livestock circular farming approach. And during anaerobic digestion, biogas is produced from the decomposition of manure and then it's reused, helping reduce manure emission, methane emissions. And also in practice, this means the manure treatment system also functions as an energy recovery system, allows biogas to partially reduce the energy use in the feed processing facilities and also the operational for the operational use. On the other side, so when I engage with a couple of Chinese companies in the past, so the company will also calculate, for example, if the company could also consider converting biogas to renewable electricity and connect to the green. So as a green electricity, what's the revenue compared to the energy compared to the reduces energy use in the operational model. So then based on their own calculation, they will decide what's the percentage of the biogas will be reused to reduce energy use and what's the percentage of the biogas will be converted into renewable energy and to connect to the grid. So after the treatment and solid liquid separation, the organic fertilizer and water fertilizer are returned to the farmland via supporting pipe network and land application systems to support crop growth and replace part of the chemical fertilizer imports, but also improve soil quality and reduce the cost of fertilizer procurement in the process of the crops planting. And more broadly, within the vertical integrated value chain, cropland cultivation connect with the feed processing, which in turn support pig production, pig farming. And then the circular model should be understood not just as a manure treatment solution, but also as integrated system linking, which can help the company meet the environmental compliance requirement. And why I mention this because China do have very restricted legal request to in pig and poultry industry for manure management and waste and pollution management. And also, this model can also reduce the cost of feed raw material procurements by local supply, and also reduce the cost of operating energy use and other benefits. Why I mention other benefits is because following, I want to introduce the China Certified Emission Reduction Scheme. Um, so CCER is the China's national voluntary carbon credit mechanism. It allows projects that reduce emissions to generate carbon credits, which can then be traded or used by companies to support their climate targets. For pig farms, the projects mostly likely to qualify are usually large scale farms, more than 500 heads of pigs with proper manure collection and also anaerobic digestion system, then some way of the recovery or using biogas. The latest pig mechanism was released in December last year, so it's a very new policy in the in Chinese agriculture system. And then the main point here is the CCER can create a market incentive for manure reduction, making better manure management not just environmental beneficial, and also meeting regulatory requirements, reducing operation costs, but also extra revenue. And here is a simple example how Chinese pig producers can generate carbon credits and make extra revenue. So basically, according to this latest pig manure management mechanism of CCER, so each pig can deliver around 0.3 to 0.35 tons of carbon equivalents by reduced methane in the qualified pig farms. Currently, the carbon price in China's voluntary carbon market is around 80 RMB per ton, is around 11 US dollars, which gives a potential carbon value of 24 to 28 RMB per pig. Individually, that may not sound very large but if you look at the right side, when you scale it up across the China's biggest pork producers, so right side are the top 10 pig producers in China. So basically, top 10 Chinese pig producers are the top 10 pig producer in the world. So, and the highlighted 5 companies is the company we are deeply engaging with in China. And then, so if you look at, for example, taking Muyuan Foods, the largest pork producer in the world. So last year, 2025, the company sold 78 million heads of pigs, which accounts to 10% of the total production in China and equal around 50% of the total EU production. And then, so in terms of this size, as maximum, so the company can generate around 1.9 billion RMB from the carbon markets. So then from FAIRR sides, I've been talking to the company, like what's the proportion of the big farms now could meet the requirements of the pig manure mechanism of CCER, and how companies will deal with this, whether they can sell into the carbon markets now, and how many revenues they can generate from carbon markets. And then what's the plan of the rest of the pig farms which are not qualified for the CCER mechanism. So the key message is here for large producers, especially CCER could help turn methane reduction into not just the benefits, but also the actual outcome would deepen the project design, providing rules and also carbon prices. And what I'm mentioning is the maximum carbon value for the company. So I think for investors, it's also very very important to follow up with the company at this point, and then to understand the company's plan for next 3 years, to understand the company's action on this. So again, taking the engagements with pork producers in China, since 2024, we've been collaborating with our Chinese member, China Asset Management, the second largest domestic asset manager in China, to co-lead the Muyuan Food Working Group and the China Climate Engagement Initiative. So we also get support by 3 Tier 1 Chinese asset managers. The working group aims to enhance the climate and nature performance of Muyuan Food, which is the largest, I mentioned, it's the largest pork producer in China and also in the world. So 2 years ago, we set up 4 sustainability goals for the company, and in April 2025, so we were glad to see the company made significant progress after several rounds of capacity building and engagement. For example, if you see the first target, the company disclosed absolute methane emission as a key source of the Scope 1 emission. And then also we've seen that the company also adds the deforestation, the supply codes of conduct, etc. And we are keeping engaging with this company with the support by Chinese asset managers, and this year will be the 3rd year. So we will also have a 3 years progress summary by the end of this year. And then, as Alice mentioned, a lot of dairy. So I also want to talk about another important sector in China, the China's dairy industry. According to FAIRR Green Tool, the methane emission from enteric fermentation and manure accounts for more than 60% of the total emission of the dairy cattle. And then in China, we have more than 12 million dairy cattle. Meanwhile, China is also importing a lot of dairy products globally. So, and we've got engaging closely with Chinese dairy companies and then also there's a lot of very good examples I can share now. So here is just quick sharing here, so financial incentives for low carbon transits. So last few years, we've seen a couple of Chinese companies, they made very good progress, especially linked to the green finance development in China. The latest one, for example, China Manure issued the 3.5 billion RMB offshore sustainable Dingsen bonds, and which interest rate is much lower than the normal bond. And then 2 weeks ago, we launched our first China-focused engagements on GHG emissions and deforestation conversion-free soya. Engagements with the Chinese dairy sectors focus on GHG emissions and deforestation and conversion-free soya, targeting 3 largest Chinese dairy processors, including China Manure, China FAIRR, and Inner Mongolia Yili, and then 1 key retailer, which they are buying this Yum China, they are buying milk products from these processors. The engagement is open sign on for all institutional investors until 24th of April. And here is the timeline of the whole engagement. Over the past few months, we've been working with internal thematic experts and external partners on methodology. And as I mentioned, we are now in the investor sign-up phase. So we are also organizing an investor trip to China in June to meet the select companies on the ground, including meet Yum China in Shanghai, meet China Manure in Inner Mongolia, and Yili in Beijing. And we welcome institutional investors to sign on the engagements in different rules. Investors have 3 options for participation. So you can be a lead investor. This investor will chair the meeting and lead the Q&A with the company. You can be a supporting investor role. You will participate in a call or an in-person meeting with a company. And you can also be an endorsing role, which allows investors who wish to show support for the engagement but won't participate in the company dialogue. Lastly, the FAIRR team has published several reports on climate, nature, and the global protein supply chain over the past 6 months, including climate risk in the soft commodity supply chain and micro resistance in the quick service restaurant supply chain and water pollution risks. Please visit our websites. And here is everything about my sharing. Thanks, everyone.